Hey folks, welcome to Market Intraday Analysis by InTheMoneyStocks.com, your leader in pure technical analysis, avoiding all that Wall Street hype. Today is Thursday, December 18th, 2008. Well, on the 18th of December, here we sit on this Thursday, folks, and we are moving into the holidays, and I want to just talk a little bit about what's going on in the markets. And one thing I want to point out on the intraday market right now is that the market actually is having a nice little sell-off in this late afternoon session. Okay, so I want to just touch quickly base on that sell-off, and we'll go into that quickly here. But nonetheless, you can see from the chart a very, very solid sell-off. You should have support at the 200 down here if we reach that. But in any case, very, very solid sell-off. You have the Dow down 183.5 points, the NASDAQ down 22, and the S&P down about 15. That's about 1.5% to 2% across the board between the Dow, S&P, and NASDAQ. Now, a couple things, folks. First of all, most of the day until just very recently, over the last half an hour, the markets were dead. And I mean literally no volume in the markets, trading sideways, up or down 3 points on the futures. And it was just a dead day, and that's what we were seeing all day. And then all of a sudden, you see a breakdown point here on the intraday chart, and I'm going to draw that in right there, and you can see very clearly that this was a key breakdown line. And notice how you hit it earlier here, and you can even extend this line to see that point here. There we go. And you can see here again. So notice the low from yesterday at the close. All right, let's first describe that. So that's your first point of interest. All right. And the second point of interest would be the low here on the second candle of the day. Then you pierce it, and you want to know, okay, well, you knew support was between this point, the low, and the point here, but you closed above it. So on the next candle, what you want to look for is, okay, well, we closed below, but remember, confirmation is one of the key things in analysis. Too many amateurs, too many beginners don't realize they need to see confirmation. And what is confirmation? Well, confirmation is a close below a trend line, and then a lower low put in on that candle, or a closing lower low. So what do we see here? Well, you have a lower low put in, but on the next candle, you don't take out the low of this candle. It's never taken out. You don't take it out. In fact, you rally back above it. That reestablishes that support line intact. Now, what does it do? It also weakens it, though. It starts to weaken that line. And here you go. You rally up and around, come back in, you test that line again, can't break it this time. Again, you test in the next candle, you rally up again, come down, hit it again, bounce right up again, do not confirm, and then again you come down, hit it, the next candle you close on it, the next candle finally breaks. So here's your breakdown, and then you want to say, well, we need this low to be taken out. Well, there it is, folks, on your low. So there's your confirmation of a breakdown. And again, you can see the sell-off taking us all the way down to just above this 200 moving average. And now look at the bounce that's coming in. All right, you can see this is live, real time as I'm making this video. The market has bounced up off that low very nicely. So again, just talking about the markets, you always want to talk about confirmation. It's a key rule in any trader's book, and at least any profitable trader. You don't want to get whipsawed because too many amateurs go long right here at the close. They say, okay, well, we closed below that breakdown line, which was the low here to the low here, and then all of a sudden, all right, let's go short. Well, guess what happens? Ouch. Right up, and they get swiped out, and they obviously have to cover and take a stop out or whatever it may be as the market rallies off that point. So it's just a matter of understanding the rules, and that's what these videos are for, folks. Not only do I want to talk about what's going on intraday, but I want to point out the key levels of the market. I want to talk a little bit about some rules and lessons in day trading and swing trading, because these rules, by the way, folks, this breakdown, this could be a daily, a monthly chart. You could be looking at it as an investor who holds for a year or two or 10 years. Doesn't matter. This can be applied to every chart out there, and that's the key. Now, let's talk a little bit more about what's going on in the intraday markets, because I want to flip back to the daily chart. You can see what's been going on, and I'm not going to go into the daily and the hardcore levels, obviously the S&P levels, the key levels in gold, oil, and the US dollar, and all the stuff that people use to trade off of our calls. I don't give out in these videos because that's available to just our subscribers online at InTheMoneyStocks.com in the research center. They get all the utilities and all the basic levels to watch for support here, resistance here, and so forth to be able to do profitable trading. But in any case, looking at the daily, you can see where we've come from. We had been calling for a low right down here. That was a call a while ago that we made on the website. Sure enough, you see the move back up. We've been calling last week for this consolidation. We got it to a T. We had gone to a neutral stance, and you can see the pop up and sideways here as we trade into options X. Now, those in the research center again will get all our up-to-date calls about what we're expecting tomorrow. I'm just going over what's happened and what have our calls been. Now, the key here, folks, is what's been going on intraday. Why are we seeing this sell-off now? Well, part of it is GM and Ford and automaker related. All right, so let's look at GM. GM, nice little dump here on the day. Look at this sell-off, and this is really what started to weaken the markets. Then you got to bounce back in GM, but notice resistance. I mean, this doesn't take a rocket scientist to understand that you'll probably see a pullback off this 20 moving average. Sure enough, you're getting that pullback on GM. That's just standard 101 support and resistance lines and moving averages. The other thing I'd like to talk about, though, is this GM and auto stuff. Really what came out was an article that said that Bush was looking into possibility or a strong possibility of doing an orderly bankruptcy for these automakers, okay? And that obviously has taken an effect on the markets. You can see what happened to GM when that news came out, and now the markets, obviously, as I flip back to the futures chart, dumped out. We can look at the SPY, which mirrors the S&P pretty well as well, and you can see it dump out as well. Now, this is just intraday. We don't know what's going to happen. Who knows what comes out before the end of the day. It's only 2:30 p.m. Eastern Time right now as I do my afternoon update video, but that is something to watch for as well. Now, a couple other things, folks. I want to talk about one more rule in trading, and I want to talk about some pitfalls that traders come into. Let's look at the dry ships chart. All right, dry ships had a nice move up here and a small pullback. Now, we had gone into a bullish stance right here. We got the pullback to 7, which we had called for, and again, that call went out on multiple places. But again, in our research center as well, we had been talking about that in the video. But nonetheless, you had this pullback, and then you see this rally up here. And one thing, a pitfall that I often find traders getting into is going long on a break of this high, a close above this high here, and let me see if I can even, let's see what we can do. Well, nonetheless. So, really, a lot of traders say to themselves, well, we closed above the high of this candle on this candle, so that must mean a breakout. And I have to stress, there's multiple reasons why you don't go long here. Number one is a double top or an M pattern usually breaks on the second high a little bit. They do that to get out stops. They do that to get people to go long before they flush it away and take their money. And you have to understand these pitfalls. And one thing I also want to announce is we're starting an article, or I'll be writing an article anyways, called Confessions of a Trader, which will be coming out. It's going to be a chapter by chapter each week, and you want to basically pay attention because it's all my learning experiences rolled into a basic small book. And again, we're going to be sending that out on our free email alerts as of tonight, so you want to go sign up for that if you want it. We'll also post it on the blog. That we're going to have a free blog coming to our website, inthemoneystocks.com, where we post, multiple people will be posting, multiple profitable traders will be posting on that as well. So you really want to come and check out inthemoneystocks.com. And obviously, those of you that want the key levels for the market need to sign up for the research center and so forth. But the reasons now why. Well, first of all, I mentioned an M pattern. Now, M patterns don't necessarily happen at the low, so make sure you understand that rule. But secondly, in this pattern here, folks, you do get a close above the high, but that's often done by the large cap or the large players to flush out the weak hands. Now, the other reason you would never go long here is because you were hitting the 50 moving average. See this line right here? This is the 50 moving average. So why would you go long right into a resistance? It's like me, instead of getting a running start at a wall to try and break down a door or a wall and going back maybe 30 yards or 30 paces and then going running, instead I stand right up an inch from the wall and I try to push my body through it. I'm not, trust me, if I had a 30-yard rush to that door, I'd have a lot better shot at breaking that door down than going from an inch away and trying to run into it from that. And that's the same principle. I mean, it's just you're using almost physics. It's almost, compare it to human life or our experiences as humans and running into a door, and it makes sense. But that's another reason why you don't do that, and you want to be very careful in that situation. And you're getting a dry ships pullback today after that close right on it yesterday. We gapped up, actually, but it wasn't able to hold that moving average. Now, before I end the video, folks, I just want to talk about 2 more calls that I made yesterday in the video in the Research Center, and this is another reason why you want to sign up for the Research Center and get these up-to-date calls. I had talked about good chance, I had said yesterday in the video, we're going to go to a pullback stance on the GLD, and then the gold. We should see a pullback off this moving average. Notice how we went above the moving average, came back and couldn't hold it, and we settled right on that 200 moving average, and then look at the pullback today, all right? Down $1.21 on the GLD, and that's all you're looking for. You're looking for a couple dollars here and there, and it was even down $1 more. As you can see, the low of that candle was a lot lower. Now, we should even go lower, but it could be gyrating there over the few days, but nonetheless, that could very well go lower. The other call I had made for was the UUP, which is a dollar index. And I said, guys, look for a bounce. You're into major support right here. Look for a bounce. Sure enough, look at that nice bounce on that chart today coming to fruition. And this is all stuff, again, that we talk about in the Research Center as we teach as well. And you have the hidden gems, which I put out one or two micro small cap plays a month that I think will outperform and possibly do 50% returns over the course of a 6-month period. We also do technical tactic, which is a lesson every month that comes out on there about how to trade technically. So you can master those lessons by every lesson we put out, and over the course of a year, you should be able to become a very good trader, or at least a better trader than you were. All right, folks, that's all for now. Have a wonderful day. We'll be back tomorrow with our next intraday video. Talk to you then. Take care.